What if I told you that while everyone's watching Silicon Valley, Africa is building the future of technology, and that the innovations happening in Lagos, Nairobi, and Accra might matter more than anything coming out of San Francisco? Stick around because the tech revolution you're ignoring is about to change everything. Picture this. It's 2007. Kenya has a problem. Most people don't have bank accounts. The banking system requires physical presence, documentation, and minimum balances that exclude the poor. But everyone has a mobile phone, so a Kenyan company called Safaricom launches M-Pesa. It's a system for transferring money using basic mobile phones. No smartphones, no apps, just text messages. Within a year, millions of Kenyans are using M-Pesa. By 2023, M-Pesa processes over $300 billion in transactions annually. It's used by over 50 million people. It revolutionized financial inclusion, and it was invented in Africa, not Silicon Valley. This is the story Western tech media doesn't tell. While everyone focuses on the latest iPhone or AI breakthrough from Google, African innovators are solving real problems with technology that actually matters. They're not building social networks for sharing photos. They're building systems that bring electricity to rural villages, that provide healthcare to people who've never seen a doctor, that create jobs in economies where unemployment is rampant, that give small farmers access to markets, that bring education to children with no schools. This is technology with purpose. Technology that improves lives immediately and dramatically. Not another app for ordering food you don't need. Today, you're getting the complete story of Africa's tech revolution. How African entrepreneurs are leapfrogging Western development, the innovations in mobile money, renewable energy, agriculture, healthcare, and education. The tech hubs emerging in Lagos, Nairobi, Accra, and Cairo. The challenges of infrastructure, regulation, and investment. Why African tech solutions might be more relevant globally than Silicon Valley products. And why you should be paying attention to what is happening in Africa. Because it has the future of technology for the majority of humanity. This isn't charity. This isn't development aid. This is innovation. Real innovation, the kind that changes billions of lives, and it's happening right now. You're just not hearing about it because Western media is too busy covering the latest drama at Twitter or whatever metaverse thing Mark Zuckerberg is failing at. But the real technological revolution, that's happening in Africa, and it's spectacular. Let's start with mobile money because it's the foundation of everything else. M-Pesa launched in Kenya in 2007, but the concept has spread across Africa. Mobile money means using your phone as a bank account. You can deposit money, withdraw it, transfer it to others, pay for goods and services, all through your phone. And crucially, it works on basic phones, not smartphones. This is important because smartphones are expensive, but basic phones are ubiquitous in Africa. Almost everyone has one. Even people living on a few dollars a day. The reason mobile money took off in Africa is because traditional banking failed. Banks require physical branches, which are expensive in rural areas. They require documentation many people don't have. Birth certificates, proof of address, formal employment. They require minimum balances. If you're living on to dollars per day, a $10 minimum balance is prohibitive. The result was that 80% of Kenyans had no access to formal financial services before M-Pesa. They operated in cash, which is dangerous and inefficient and excludes you from the formal economy. M-Pesa changed this. Overnight, you register with your phone. You deposit money at an agent who could be a corner store owner. The money is credited to your phone account. You can send it to anyone with a phone number. They withdraw it from their local agent. Simple, fast, cheap. No bank account needed. No credit check. No minimum balance. Just a phone and an ID. This brought financial services to millions who were excluded before. And once people have access to financial services, everything else becomes possible. They can save money securely. They can send remittances to family in rural areas. They can receive payments for goods and services. They can access credit. They can start businesses. The impact was transformative. Studies show M-Pesa lifted 2% of Kenyan households out of poverty. That's roughly 194,000 households. 200,000 families escape poverty because of a mobile money system. This is real impact, not engagement metrics or user growth. Actual lives improved measurably. And this wasn't done by Silicon Valley. It was done by Africans solving African problems. The lesson here is important. The biggest tech impacts don't come from incremental improvements to luxury services. They come from bringing basic services to people who never had them. Mobile money has expanded beyond Kenya. Tanzania, Ghana, Uganda, Rwanda all have mobile money systems. These systems now interconnect. You can send money from Kenya to Tanzania instantly. This is creating a pan-African payment network, and it's enabling everything else. Because once you can transfer money digitally, you can build other services on top: e-commerce, digital lending, insurance, investment platforms, agriculture marketplaces, energy payments. Mobile money is the infrastructure layer that makes everything else possible. Let's talk about energy. Over 600 million Africans lack access to electricity. That's half the continent. Without electricity, you can't refrigerate food or medicine. You can't charge phones. Children can't study after dark. Economic activity stops at sunset. The traditional solution is extending the electric grid. But that's expensive and slow. Building power plants and transmission lines to every village takes decades and billions of dollars. Most African governments can't afford it, so millions remain without power. African companies found a different solution: off-grid solar, small solar panels that power individual homes. These systems are cheap. A basic system costs $100 to $200. It provides enough power for lights and phone charging. Larger systems can power TVs and refrigerators. The innovation wasn't the technology. Solar panels exist everywhere. The innovation was the business model. How do you sell a $200 system to someone earning $2 per day who has no savings? The answer is mobile money. Companies like MKOPA in Kenya sell solar systems on payment plans. Pay $15 upfront, then pay 50 cents per day using mobile money. After a year of payments, you own the system. This pay-as-you-go model, enabled by mobile money, made solar accessible. Customers were already spending money on kerosene for lamps and charging phones at kiosks. The solar payments were equivalent to what they were already spending. But now they got reliable electricity. No more kerosene fumes. No more walking to charging stations. Just flip a switch and lights work. M-Pesa has connected over 3 million homes. That's roughly 15 million people who now have electricity. Light, another company, has reached 100 million people globally, mostly in Africa. This is electrification at scale, faster and cheaper than grid extension, and it's creating a distributed energy system that's more resilient. No central infrastructure to fail or be targeted. Each home has its own power source. This leapfrogs the centralized grid model that the West built. Africa is going straight to distributed renewable energy, and it's happening faster than anyone expected. Agriculture is being transformed by mobile technology. Most Africans work in agriculture. Small farmers growing crops for local markets. These farmers face enormous challenges. They don't know market prices, so middlemen exploit them. They lack access to credit, so they can't invest in better seeds or equipment. They don't have weather information, so they plant at wrong times. They can't access agricultural advice, so they use inefficient techniques. The result is low productivity and poverty. Mobile platforms are solving these problems. Farmers connect through phones to get market information. They can see prices in different markets and choose where to sell. This eliminates middlemen and increases farmer income. They can access weather forecasts and planting advice via SMS. They can get agricultural tips from experts. They can access credit through digital lending platforms. and they can sell directly to buyers through marketplace apps. Twiga Foods in Kenya connects farmers directly to urban vendors. Farmers list their produce on Twiga's platform. Vendors order through the app. Twiga handles logistics, getting produce from farms to vendors overnight. This is faster and more reliable than traditional supply chains. Farmers get paid fairly and promptly. Vendors get consistent supply. Everyone wins except the middlemen, who were extracting value without adding it. Twiga has grown rapidly and is expanding across Africa. Similar platforms exist in Nigeria, Ghana, and other countries. They're digitizing agricultural supply chains and making them more efficient. The impact on farmer income is significant. Studies show farmers using these platforms earn 10 to 30% more than those using traditional channels. That extra income is transformative for families living on the margin. It's the difference between children going to school or working, between having enough food or going hungry. Technology, creating real value, not engagement metrics, not ad revenue. Actual income for people who desperately need it. Healthcare is another area of massive innovation. Africa has a few doctors and hospitals. The World Health Organization recommends 1 doctor per 1,000 people. Most African countries have 1 per 5,000 or worse. Rural areas might have 1 per 50,000. This means most people never see a doctor. They rely on traditional healers or undertrained practitioners. Diseases that are easily treatable become deadly. Maternal mortality is high. Child mortality is high. Life expectancy is low. Healthcare access is a crisis. Telemedicine is part of the solution. Doctors in cities can consult with patients in rural areas via video call. This extends the reach of limited medical professionals. But connectivity is a challenge. Internet access is limited in rural areas. Video calls don't work on slow connections. So African companies are innovating around constraints. Babylon Health operates in Rwanda with text-based consultations. You describe symptoms via text. An AI triages and either provides advice or connects you with a doctor. This works on basic phones. With minimal data, Parma is tackling medicine access. Africa has medicine supply chain problems. Rural pharmacies often lack essential medicines. What they have might be expired or counterfeit. Parma creates a network of pharmacies with reliable supply chains. They use data to predict demand and ensure stock. Patients can find medicines through the Parma network, and they can pay in installments through mobile money. Chronic disease medications are expensive. Paying monthly is more manageable than paying upfront. This model improves medication adherence, which improves health outcomes. Zipline delivers medical supplies by drone. In Rwanda and Ghana, Zipline operates drone delivery of blood, vaccines, and medicine to remote health facilities. A health facility texts their need. A drone is dispatched from a distribution center. It flies to the facility, drops the supply by parachute, and returns. This is faster and more reliable than roads, which are often impassable, especially in rainy season. Zipline has delivered over 4 million medical products. They've probably saved thousands of lives by getting blood to hemorrhaging patients or vaccines to remote areas. This is drones used for something meaningful, not delivering burritos to lazy people. Education technology is expanding access to learning. Many African children don't attend school. Schools don't exist in their area, or their families can't afford fees, or children need to work. The result is low literacy and limited economic opportunity. EdTech is trying to fix this, but it faces the same connectivity challenges. Most educational technology assumes high-speed internet and computers. Africa has neither at scale. Ineza Education in Kenya delivers education via SMS and basic phone apps. Students can access lessons and quizzes on any phone. Teachers can track progress. Parents can see what their children are learning. This works on the technology people actually have. It's not as rich as video lessons, but it's better than nothing. And for millions of children, nothing is the alternative. Ineza has reached over 5 million students. That's 5 million children getting education they wouldn't otherwise access. M-Pesa uses AI to personalize learning via SMS. Students receive questions matched to their level. The AI adapts based on their answers, getting harder or easier. This personalized learning was previously only possible with one-on-one tutoring. M-Pesa delivers it at scale through basic phones. It's not perfect, but it's democratizing personalized education, and it's working with African constraints, not assuming Western infrastructure. BRCK makes rugged education technology for African conditions. They build tablets that are durable, have long battery life, and can download content over spotty internet connections. Schools buy BRCK devices and a local server. Content is loaded on the server. Students access it locally without internet. This solves the connectivity problem. The content is cached locally. Students and teachers have reliable access regardless of internet quality. BRCK is used in schools across Africa. It's technology designed for the environment it'll be used in, not transplanted from California. Fintech beyond mobile money is exploding. Once mobile money provided the rails, other financial services became possible. Digital lending platforms use mobile money transaction data to assess creditworthiness. If you've used mobile money responsibly for 6 months, you can get a small loan. No paperwork, no collateral. The loan is approved and disbursed in minutes. Interest rates are high because risk is high. But for someone with no access to formal credit, it's the only option. And for small businesses, access to credit is the difference between growth and stagnation. Branch and Tala are leading digital lenders. They operate in Kenya, Tanzania, Nigeria, and other countries. They've issued billions in loans to millions of people. Default rates are higher than traditional banks, but the volume makes it profitable, and they're using data to improve credit models. As more transactions happen digitally, more data exists. Better data means better credit assessment, which means lower rates. The system is improving over time, and it's bringing credit to people who were excluded before. Insurance is being innovated too. Traditional insurance requires regular premium payments. Poor people can't afford regular payments. Their income is irregular. Some months they have money, other months they don't. Traditional insurance doesn't accommodate this, so people go uninsured. When disaster strikes, they're wiped out. This perpetuates poverty. One drought, flood, or illness, and they lose everything. Microinsurance products allow flexible payments. Pay premiums via mobile money when you can. If you miss payments, coverage lapses, but you can restart. Pull-up partners with agricultural companies to provide crop insurance to smallholder farmers. If rainfall is too low, farmers automatically receive payouts. No claims process, no paperwork. It's indexed to rainfall data. If it doesn't rain enough, payouts are triggered. This protects farmers from drought and enables them to take risks like investing in better seeds. Knowing they're insured, they can invest more. This increases yields and income. E-commerce is adapting to African realities. Jumia is often called the Amazon of Africa, but it's very different from Amazon. Most Africans don't have credit cards or addresses. You can't just enter an address and credit card number, so Jumia adapted. You can pay cash on delivery. You pick up from a local agent instead of home delivery because addresses don't exist or aren't accurate. Jumia became a logistics company as much as an e-commerce platform. They had to build the infrastructure Amazon assumes exists. This is harder but necessary. Jumia operates in over a dozen African countries. They're not profitable yet, but they're building the foundation for e-commerce in an environment with no existing infrastructure. The logistics challenges are immense. Roads are poor. Addresses don't exist. Postal systems are unreliable. So companies are innovating. Sendi is a logistics platform connecting businesses with motorbike and truck drivers. It's like Uber for deliveries. Businesses post delivery jobs. Drivers accept them. This creates a gig economy for logistics and makes deliveries faster and more reliable. Kobo 360 does this for trucking across West Africa. They're digitizing freight and making it more efficient. These companies are building logistics infrastructure that didn't exist, enabling e-commerce and broader economic activity. Tech hubs are emerging in major cities. Lagos, Nigeria is the most prominent. Lagos has a vibrant tech ecosystem, hundreds of startups, multiple incubators and accelerators, tech events and conferences. Lagos is producing billion-dollar companies. Flutterwave, a payments company, is valued at over $3 billion. Andela, which trains software developers, raised hundreds of millions. Paystack was acquired by Stripe for $200 million. These are significant outcomes. Lagos is proving African startups can compete globally. Nairobi, Kenya is another major hub. It's called Silicon Savannah. Nairobi produced M-Pesa. It's home to iHub, one of Africa's first tech incubators. Kenyan startups in fintech, agtech, and clean energy are attracting international investment. Nairobi has advantages. Kenya has relatively good infrastructure. The government has been supportive of tech, and there's a critical mass of talent and capital. Accra, Ghana is rising rapidly. The Ghanaian government has prioritized tech. They created incentive programs for tech companies. They improved digital infrastructure. The result is a booming startup scene. African fintech, health tech, and edtech companies are choosing Accra. The city is attracting international attention. Twitter chose Ghana for their African headquarters, though the decision became complicated after Elon Musk's takeover. Cairo, Egypt has a large, educated population and strong technical universities. Egyptian startups in e-commerce and mobility are succeeding. Cairo has produced several unicorns, startups valued over $1 billion. The ecosystem is more mature than most African cities, and proximity to Europe and the Middle East gives Cairo geographic advantages. Cape Town, South Africa has been a tech hub for longer. South Africa has better infrastructure than most African countries, but it's also more developed, which means different problems than the rest of Africa. Cape Town startups often don't face the same constraints, so their innovations are different. They're more similar to Western startups. This is both good and bad. Good because they can scale more easily. Bad because they're not solving uniquely African problems that could scale across the continent. The investment landscape is improving. For years, African startups struggled to raise capital. Western VCs didn't understand African markets. They saw only risk, not opportunity. African investors existed, but had limited capital. The result was talented entrepreneurs with great ideas but no funding. This is changing. More international VCs are paying attention. Andreessen Horowitz, Sequoia, and other top-tier firms are investing in African startups. Dedicated Africa-focused funds have raised billions, and African investors are growing. More successful entrepreneurs are becoming angel investors, recycling capital into the ecosystem. The amounts are still small compared to Silicon Valley. $10 million raised in Africa is major news. In the Valley, it's seed round, but the capital requirements are different. Customer acquisition costs are lower, labor costs are lower. You can build more with less in Africa. So while absolute numbers are smaller, the impact per dollar is often larger, and the trajectory is upward. Investment in African startups increased from $1 billion in 2019 to over $6 billion in 2022. This is exponential growth, and it's accelerating. The diaspora is crucial. Millions of Africans live abroad. They send remittances home, over $100 billion annually. But increasingly, they're investing in African startups. They have capital from careers in the West. They understand African markets from their backgrounds. They're the perfect bridge investors. And some are returning to start companies. Brain drain is becoming brain circulation. Africans trained in Western universities and companies are bringing skills home. This talent, reverse migration, is accelerating innovation. The challenges remain significant. Infrastructure is the biggest. Internet connectivity is limited and expensive. Electricity is unreliable, roads are poor. This makes doing business harder. startups must account for these constraints. They must build redundancy and resilience. A company in San Francisco assumes power and internet work. An African company can't. They must design for intermittent connectivity and power outages. This is harder, but creates more robust solutions. Regulation is another challenge. Many African countries have outdated regulations, laws written before internet existed. Governments often don't understand technology, so they over-regulate or regulate incorrectly, or they fail to provide legal clarity, creating uncertainty. Some countries are better. Kenya, Rwanda, and Ghana have relatively progressive tech policies. Others are hostile. This regulatory fragmentation makes scaling across Africa difficult. Each country has different rules. A product that works in Kenya might be illegal in Nigeria. This slows expansion. Corruption is a persistent problem. Bribes are often necessary to do business. Government contracts are awarded based on connections, not merit. This disadvantages startups without political ties. It wastes resources on bribes instead of growth, and it creates moral hazards. Entrepreneurs who pay bribes normalize corruption. Those who refuse are at disadvantage. Some countries are better than others. Rwanda has low corruption, Nigeria has high corruption. But it's a challenge across the continent. Human capital is mixed. Africa has millions of young people. Demographics are favorable, but education quality varies. Many young Africans lack skills employers need. Tech companies struggle to hire despite high unemployment. This is improving. Coding bootcamps and training programs are expanding. Companies like Andela train developers and place them with international companies. But there is still a gap between available jobs and qualified candidates. The mobile-first approach is Africa's advantage. The West built technology for computers, then adapted for mobile. Africa skipped computers and went straight to mobile. This means African solutions are mobile native. They're designed for phones, especially basic phones. This is increasingly relevant globally. Billions of people in Asia, Latin America, and even rural America access internet primarily through phones. African innovations designed for mobile constraints are more relevant to most of humanity than computer-centric Western products. The constraint-driven innovation is powerful. Silicon Valley operates with abundant resources, cheap electricity, fast internet, access to capital, talented workforce. When resources are abundant, you optimize differently. You can throw money at problems. African entrepreneurs don't have the luxury. They must be creative. They must do more with less. They must innovate around constraints. This produces different, often better solutions. Solutions that work in difficult conditions. Solutions that are more efficient. Solutions that are more resilient. And increasingly, these African solutions are being deployed globally because they work better in resource-constrained environments. The social impact focus is different from Silicon Valley. Western tech companies chase growth and profitability. They solve first-world problems. Apps for ordering food, streaming video, social networking. These are nice to-haves. African tech companies solve problems of survival, access to electricity, financial services, healthcare, education. These are needs, not wants. And solving real needs creates sustainable businesses. People pay for things they genuinely need. The market is massive. Billions of people need these services. The companies providing them are building huge, valuable businesses while improving lives. This is capitalism at its best. Profit and purpose align. The China relationship is complex. China is investing heavily in African infrastructure, roads, ports, telecommunications. This creates opportunity and dependence. Chinese companies are also entering African tech markets. They bring capital and expertise, but they also compete with local companies, and there are concerns about data security and sovereignty. Chinese tech companies may share data with Chinese government. This threatens African privacy and independence. The relationship benefits Africa in some ways. Chinese investment accelerates development, but it also creates risks. African countries must navigate carefully. The climate opportunity is enormous. Africa has abundant renewable energy potential: solar, wind, hydro, geothermal. The continent could be powered entirely by renewables, and the lack of existing infrastructure is actually an advantage. There's no fossil fuel infrastructure to strand. Africa can build clean from the start. This is the ultimate leapfrog, skipping fossil fuels entirely and going straight to renewable energy. And African innovation in off-grid solar is exporting to other developing countries. What works in Kenya can work in India, Philippines, or Bolivia. African climate tech might be the most globally relevant tech coming out of the continent. The African Continental Free Trade Area (AfCFTA) is a game changer. It's the largest free trade zone in the world by number of countries. 54 countries representing 1.3 billion people and $3.4 trillion in GDP. If successfully implemented, AfCFTA will create a single African market. Goods, services, and people will move freely. This eliminates the regulatory fragmentation that currently limits scaling. A startup in Nairobi could expand to all of Africa without navigating 53 different regulatory regimes. This makes African startups dramatically more attractive to investors. The potential market is huge, and it's growing. Africa's population will double by 2050 to 2.5 billion. A quarter of humanity will be African. The market opportunity is staggering. Africa's tech revolution is real. It's not potential. It's not future. It's happening now. African entrepreneurs are solving massive problems with technology that actually matters. They're bringing financial services to billions excluded from banking. They're electrifying homes without waiting for grids. They're connecting farmers to markets and increasing incomes. They're delivering healthcare to people who've never seen doctors. They're educating children with no schools. This is technology with purpose. Technology that creates immediate, measurable impact on human welfare. The innovations are different from Silicon Valley because the problems are different. Africa doesn't need another social network or food delivery app. It needs electricity, financial inclusion, healthcare access, education, and economic opportunity. African tech companies are providing these, and they're doing it profitably. These aren't charities. They're businesses building sustainable solutions to massive markets. The profit motive and social impact are aligned. This is what technology should be. The mobile-first, constraint-driven approach produces solutions that are increasingly relevant globally. Most of humanity lives in conditions more similar to Africa than Silicon Valley. They have smartphones, not computers. They have spotty internet, unreliable electricity, limited incomes. African tech, designed for these constraints, works for billions of people worldwide. Indian farmers face similar challenges to Kenyan farmers. Filipino fisherfolk could use the same tools. Brazilian favela residents have similar needs to Lagos slum dwellers. African innovation is more globally applicable than American innovation because it solves universal problems, not luxury market problems. The investment is accelerating. What was a trickle 5 years ago is becoming a flood. Billions of dollars are flowing into African tech. International VCs are opening African offices. Local funds are growing. Successful entrepreneurs are recycling capital. The ecosystem is maturing rapidly, and this is creating a positive feedback loop. More capital means more successful companies. More success means more attention and more capital. Africa is becoming a serious tech ecosystem that global investors can't ignore. The diaspora is returning. Africans trained abroad are bringing skills and capital home. They're starting companies. They're investing. They're mentoring. This reverse brain drain is accelerating development, and it's creating bridges between Africa and the rest of the world. Diaspora entrepreneurs understand both African markets and global standards. They can build world-class companies that solve African problems and scale globally. The young population is Africa's advantage. Africa has the youngest population of any continent. Median age is 19. compared to 38 in the US and 43 in Europe. This is a massive workforce, and increasingly, it's an educated, tech-savvy workforce. Young Africans are digital natives. They grew up with mobile phones. They're comfortable with technology. They're entrepreneurial because formal employment is scarce. This combination of youth, digital literacy, and entrepreneurial necessity is creating a generation of innovators. The challenges are real and significant: infrastructure gaps, regulatory uncertainty, corruption, skills shortages. These are not insurmountable, but they're hard, and they slow progress. But African entrepreneurs are navigating them. They're building businesses despite difficulties, and each success makes the next one easier. Infrastructure is improving. Regulations are modernizing. Corruption is declining in some countries. The trajectory is positive. The Western tech world should pay attention, not out of charity or development goals, but because Africa is where significant innovation is happening. The next billion-dollar companies might come from Lagos or Nairobi, not San Francisco. The solutions to global problems might be developed in Accra, not Cambridge. Africa is not just catching up. In some areas, it's leaping ahead. Mobile money is more advanced in Kenya than in America. Off-grid solar deployment is faster in Africa than anywhere else. Africa is innovating at the frontier, not copying Western models. The narrative needs to change. Africa is not just poverty and problems. It's innovation and opportunity. The biggest market opportunity of this century. A quarter of humanity, mostly young, rapidly urbanizing, increasingly connected, hungry for products and services. This is where growth happens. This is where massive companies are built. This is where technology creates real impact. Not incremental improvements to luxury services, but fundamental access to basic services that improve life measurably. The African tech revolution is the story of the next decade. It's the story you should be following. Because while everyone's watching Silicon Valley drama and AI hype, African entrepreneurs are quietly building the future. They're proving that technology can be a force for genuine good, that profit and purpose can align, that innovation happens everywhere, not just in wealthy countries, that the best solutions come from the people closest to problems. Africa's tech revolution isn't a side story. It's the main event, and it's spectacular. You just haven't been told to pay attention. Until now, watch the next video to discover how Indian tech companies are challenging Silicon Valley dominance and why the future of global technology might be written in Bangalore, not San Francisco.